The commercial real estate lending industry is a complex conglomeration of different team players or fields of expertise. Each player has a very important role in finalizing the ownership and management of a commercial real estate property. The commercial lending industry is one of the most complicated yet fascinating sectors in the world. By enhancing your understanding of the key players involved, you will be able to build a foundation of knowledge which will enable you to have continued professional success. In this module, we will give you the keys to your success by defining these banking players and how they connect to your role as a future loan associate. The banking industry is complex, which contains many revenue sources. Banks generate revenue in many different ways. The following is an explanation on how banks generate revenue and its pertinence to the commercial lending industry. This is in no way meant to be an all-inclusive summary. However, it will shed some light on how things work within the banks and what their motivations are. Banking institutions take in money or deposits in the form of CDs, savings, money market, and checking accounts. To do this, they offer consideration to the client in the form of interest paid on the balance. The longer the money is locked in to these CDs, the higher the interest rate paid. These deposits are banks' liabilities, meaning they owe this money to the client, you and me. As you may know, banks lend money as well. However, when a bank lends money, it does so at a higher rate or the deposited amount. Some interest rate differential that is above the rate that it pays to the funds that are deposited. The rate it pays on its deposits is called the bank's cost of funds. The bank profits from the difference in the rates on what it pays versus what it collects. Another way the bank earns revenue is that it charges the public fees for the loan it originates. These fees come in the form of origination, processing, underwriting, registration, doc prep, credit report fees, and possibly even commitment fees. It also charges service fees on the funds that are deposited as well. How do all these items pertain to the commercial lending industry? One needs to understand the motivations of the bank if he or she is to successfully navigate the lending process. There are several different levels of people that work at the given bank. For our purposes, we will start with the business development officer. This position has some variation within the industry regarding title, but the position is basically the same. The business development officer, or BDO, could be a vice president, commercial loan officer, and is responsible for generating commercial lending business. In many cases, they are rewarded from bringing in the personal and business deposit accounts for the client as well. This is typically a salaried position that may or may not include a portion of potential income that is based on loan volume, dollar amounts of funding, and business deposit relationships. The BDO is typically the first point of contact with a banking institution when bringing a transaction in. This is the person you will explain your transaction to, send a summary, and possibly even submit a complete lending package to. The business development officer will evaluate the package and request any additional information that is missing. The BDO then will give you their opinion as to whether or not their institution is interested in looking further at the transaction. They may or may not have to take your transaction to an underwriter or committee before issuing a letter of interest or an LOI. It is vital that you properly assess the quality of the BDO you deal with. Not are all created equal. We are seeking people who are smart, humble, quick to respond, and have a deep understanding of their bank's approval process. Assuming that you've made it past the LOI and you're on to the next phase, you will need to supply the bank with the contents of a full package, gather the third-party fees or registration costs from the borrower, and get them to the bank. The appraisal will be ordered, and once it comes back, the final underwriting will commence. This will consist of one or more of the several scenarios. The loan file worked on by you, the BDO, the underwriter, and perhaps even a processor will go to the following. First is the underwriter. He or she will decide the loan, give it a final review, and await arrival from the appraisal. This person is getting the package ready to send to a full committee for a loan commitment. A group of senior bank officers or its board will meet and go over a certain number of transactions for that given week. At the end, they will vote to decide if your loan should receive full approval. It is due to this process that it is absolutely critical that your loan file and due diligence be of the best quality. If they have to work hard to understand the loan, they will decline it. The one who does all of the busy and tough work is the loan processor, who typically handles the file during the period prior to submitting to underwriting and even going in committee. A good loan processor will make the difference between not only a loan being approved or declined, but also the ease by which the approval is being obtained. This individual can sometimes, who's the chief credit officer, be one and the same as the underwriting. Their primary responsibility is to manage the quality of the portfolio. From time to time, they will also have voting authority in the decision-making process. If there's anyone within the organization that's going to know whether your deal is going to fly or not, this will be the one. Well, my friends, these are all the players who you will interact with at the bank level in our particular industry. So I hope that you enjoyed a little bit more about this specific segment in the commercial lending industry.